Welcome to This Week on Wall Street, your essential briefing into what matters most in markets. I'm Matt Weinschenk. I'm the Director of Research here at Stansberry Research. Now, I need to tell you something that might surprise you. If you looked at one corner of the market right now, you'd think we were back in the wild bull days of the dot-com boom. In fact, this group of stocks has handed lucky investors multiple chances to double their money in a single day. But here's the thing. It's both a massive opportunity and a warning. So let me walk you through exactly what's happening, and stick around because I'm going to bring in an expert who will show you how to find profits in these stocks while keeping your capital safe. So I am talking about a red hot wave of IPOs, or initial public offerings. These are when stocks hit the market for the very first time. It's how companies raise cash, it's how early investors cash out, and how regular folks like us can get our first shot at owning a piece of these businesses. Now, the IPO market had been dead quiet. If you remember that crazy bull run in 2020, at that time, companies were going public left and right thanks to cheap money and sky-high valuations. But after the market crash of 2022, everything changed. IPOs slowed to a crawl, companies pulled their plans to list, and decided to wait for better days. Well, those better days are apparently here, and what I'm seeing should make every investor sit up and pay attention. So let's look at some IPOs. Take CoreWeave. This company powers AI applications in the cloud. Basically, they're a picks and shovels play of the AI gold rush. And they started as a crypto miner back in 2017, but then pivoted to AI infrastructure. But here's where it gets wild. They went public in March at $40 per share. They quickly shot up to $60, and now it's above $170 a share. So this is a company worth $82 billion. Or you could look at Circle Internet Group. They run blockchain payment networks, but their main thing is the USDC stablecoin that holds nearly $60 billion in assets. So Circle went public at $31 in early June, and the next day it was at $83. And today it's around $140. But that's not all, there's more. Since May alone, we have seen stockbroker app eToro jumped from 52 to 75. Digital health company Hinge Health rocketed from 32 to 42 in just 2 days. Ryan Reynolds-backed MNTN advertising platform soared from 16 to 27 in just 2 days. The drone maker Aero shot from 10 to 30 in just 2 days. And defense company Voyager went from 31 to 50 in just 1 week. So these aren't just good returns. These are stocks that double in days, not years. So IPO surges like this can double your money in just a couple days. They create millionaires overnight, but you do have to be careful because many times these gains are not sustainable. Let me tell you about Newsmax, right? This alternative cable news company went public at $10 per share in late March. Within days, it hit $230 per share. Now, whatever you think of Newsmax as a business, this was pure madness. The company brings in about $170 million in revenue, but at its peak, the stock was valued at $29 billion. So that's not investing. That was clearly a gambling meme stock frenzy situation. And no surprise, Newsmax has been sliding steadily downward ever since. So here's the harsh truth. If you look at the data, Professor Jay Ritter at the University of Florida studied over 40 years of IPOs. He found 316 stocks that doubled in their first day of trading. And nearly 90% of those hot IPOs had negative returns after 3 years, and the average loss was 46%. So some of these businesses will thrive and justify their crazy valuations, but history tells us that most won't. So what we have here is opportunity, but you need to tread carefully, and we'll talk about how to do that in a moment, because I want to talk about what worries me from a broader perspective, and that this IPO boom really tells us that investors are happy to take big risks right now and chase the next big score, right? The market has been on a tear since the April bottom brought on by what we call the tariff tantrum. But it's not just that stocks are up, it's what's leading the charge that concerns me. So since April 8th, the leaders have been Bitcoin, IPOs, and tech stocks. Meanwhile, boring stuff like consumer staples and healthcare can't catch a break. So the riskiest assets are on the rise and the safe ones are being left behind. This isn't a big surprise, right? Coming out of a market dip, often the things that fell the most will deliver the biggest rally when stocks bounce. But here's what I want to watch out for. all of this risk taking doesn't match up with what we're seeing in the headlines. Tariffs are still looming. A recession might be around the corner. We've got a serious budget crisis brewing, and the world is sitting on the edge of a major war. So that doesn't sound like a risk everything environment to me. And that's why I'm tilting towards a more defensive stance right now. Now, I'm saying stay invested. I'm saying stay bullish, but conservative investments will pay off over time. But I think you should be out there watching carefully for opportunities. That's exactly why I brought in Lou Basenese. Lou hosts The Big Skinny. It's a weekly live show covering markets that you can catch on YouTube. It's very informative, but it's also a lot of fun, so you should check that out. But I've known Lou for a very long time. He gave me my first shot as an analyst almost 2 decades ago, so that means you can blame him for all the bad stock picks I've made since then. But at the time, we worked together to run an advisory that specifically traded IPOs as they hit the market. So Lou's a real expert in this stuff, focuses on disruptive technology, patents. You might also know him from his appearances on Fox Business. But today we're going to talk IPOs. Lou, thank you very much for joining me.
And it's great to be here, but it's also a reminder how old I'm getting if you got your start with us 20 years ago, buddy.
I know, 20
You haven't
years.
aged a bit, and man, I'm no surprise you're a rock star in your own right now. So it's what we always anticipated. So glad to be here with you.
Thanks, Lou. I owe a lot to you for it, and I'm getting up there in years, but hopefully we can keep it off the face for as long as we can. So let's start with the basics. Can you give our viewers the 1 minute, 2 minute version of what an IPO is, how these things get priced, and why they tend to pop when they start trading?
Yeah, sure thing. I mean, IPO is the first chance the public gets to own a private company. Now, most of these that are coming to market were backed by venture capitalists. So they've been private and growing for anywhere from 5 to 10 years on average. You've seen a little bit of a backlog, so they're getting older in the private markets. But they decide they're going to go public and they hire an investment banker. And the way these things get priced is they try and figure out what's fair value in the market, right? What is someone willing to pay for a fintech? They do that by going on the road and meeting with investors and talking about their business fundamentals. And then they get an order book of basically, hey, this institutional investor is interested for $10 million. They give a pricing range. And ultimately, the job of the investment banker, they're trying to balance two things, is raise as much money as possible for the company at the highest price, because that prevents dilution but gives them capital. But at the same time, they have to make sure there's aftermarket demand so that when it begins trading, that there's going to be more buyers, and that keeps the price stable, because it's the worst possible thing is if you price an IPO at 15 and it breaks deal price, right? It's a bad omen. So that's what you look at a lot of these companies now. If for instance, you're talking about ones that are doubling within days. That means most likely the bankers underpriced it, right? Because there was more demand. They could have gotten a higher price. So from the company's perspective, they're more happy. I think what you're seeing is they're just happy to get public, right? They've been sitting and waiting in the private markets. They'll take a lower price, more dilution to do that. So, historically, everyday investors like you and I and our audience didn't have a chance to buy these IPOs, right? Like if you had a brokerage at Morgan Stanley or Schwab, you might get 100 shares. So when you look at IPOs, you really got to be thinking about buying once the trading starts, because you're not going to get that sweetheart deal. Say it prices at 15, that first trade, it's not uncommon if there's a big demand that it opens at $30 or $40 per share. So, you got to be thinking about, if I buy this, am I happy getting, a price that's materially higher than IPO shares? And I think that's the trick.
Right. So if you're lucky, you can get in at that offer price. It's a little easier now in recent years. Sometimes some of these brokerages have a few more shares, but you can get in at that
Agreed.
Offer price. But usually you can't get that, and you have to start looking at it in the aftermarket and see it's already got that jump. Companies want to jump, like you said. They are willing to leave some money on the table to sort of start with some good momentum. But you think someone with a trading mindset can do well, monitoring and finding these opportunities. So how do you approach that if you're looking at the aftermarket, the first trading price?
Yeah, no, this is a great question. I will direct readers, we have a limited time here. You referenced the Warren Buffett of IPOs, and that's Jay Ritter from the University of Florida, my alma mater. His data goes all the way back to the beginning of time. And it really helped me construct a trading strategy from what happened. So I think you need 5 factors to really look at an IPO that's worth buying. One just has to do with age. Is it 10 years old? Was a company founded 10 years or more ago? Because the companies that have that life cycle and average age coming to the markets tend to do the best. If you look at the dot-com days, most of those companies were coming public only 4 to 5 years after being founded. Too early, too premature. Most of them failed. So age, then you got to look at revenue. Do they have more than 50 million in revenue in the last 12 months? If so, those companies tend to perform the best because they're established, they're growing. That's the third thing. Are they growing? I mean, buying into an IPO is buying into the future of some new big trend or company. So you want to see that growth accelerating, not decelerating. Hallmark number 4 would be profitability, right? Like you're buying the future profits of companies. A lot of the IPOs that tank and fail are the ones that come to market that aren't profitable yet. So you want to look for the ones that are profitable or about to turn to profitability. And then the last thing comes down to valuation, which is the hardest, right? You don't want to overpay. So it's a new company. Where's it coming to market relative to its peers? And that is, determined at the last minute where they price and where it begins trading. So you have to do all your work before trading begins. And if it checks all the 4 boxes except for valuation, you want to wait to see where the opening price is. And then, for instance, companies like Arm Holdings or Astera Labs, they came to market at pretty compelling valuations where you could freely buy it in the aftermarket knowing that you're getting a good deal. And, Arm Holdings is up about 150% since its IPO a year and a half ago. Astera Labs is up about 80% since, I think it was March of last year. So those 5 fundamentals really help guide you and get rid of a lot of the junk. Like this year, there's been 89 IPOs, which is up about 40% from last year. If you think about it, it's June. Can you go through 90 companies quickly with a 5, factor checklist and look at them? And yes, you can, to get down to maybe 4 or 5 that are meaningful. So I think it's a realistic trading strategy because you only get a couple opportunities, maybe once every quarter or so.
And the way I think of it, you have these basic measures for what's a quality company, and it's pretty clear why a company is going public when you start to dig in. There's a young, profitable, well-run company that needs capital to grow, and then there's like the management cash out, right? The early investor cash out. We just want to get public and get our shares sold to someone else. And you can sort those out fairly quickly, I think, with this sort of 5-factor checklist, right?
Yeah, and I think that you put your finger on another one, like insider ownership. Are the management teams going to have good ownership after the fact? Because if they do, then they're incentivized for it to do really well instead of just cash out.
Yeah. So when you look at these factors, are there any upcoming IPOs that our viewers should watch out for that you like?
Yes, some of them just hit, right? Like Circles was very interesting to me. I didn't trade it, but there's one that's in the works that hasn't filed their official forms yet with the SEC. It's a British fintech named Revolut. It's basically fintech alternative banking, and they're going to start moving into the U.S. markets if they haven't done so already. And it's an interesting one. It's founded by 2 really smart guys. One's a French, Ukrainian, Russian. The other one's a French, I can't remember Russian. It's a great mix of just a lot of talent internationally. They're having significant success in Europe. In the alternative banking, we've seen that happen here with companies like Numerated and other fintechs that have done fantastically well. It's growing very fast. They're going to expand into other product lines and markets in the capital markets and provide an alternative to traditional banking. So they're thinking about listing on the NASDAQ. We should get some final word there in the next quarter or so. I think, to your point, the recent activity is going to bring a lot more companies public now. So this is a really good time to start thinking about trading IPOs, because there's been a backlog of companies waiting to get public that are really high quality, have been continuing to grow. When they see the price reaction of the latest batch of IPOs, they're absolutely going to be on the phone with the banker saying, hey, it's time to go. Let's do this. So I would be monitoring. There's a great website that you can monitor for free. It's Renaissance Capital. It's IPO Index, I think, or IPO Fund. They have an ETF. Ticker is rightfully IPO. But they do a lot of research. It makes it really easy to dig into what deals are coming, which ones just filed, pricing and timing. So that would be the first start. If you look at, Yahoo Finance is your first destination for any stock. If you're looking at IPOs, the Renaissance Capital website should be your first destination.
Yeah, and to lay out how this works for people, when these companies are close to filing, they'll file what's called the S1, which is kind of like their first, it's called the prospectus. It's their first big report that details all their revenue and everything. And even if you're not going to trade IPOs, those are so fun to read because they just share, it's generally some new kind of business, a new business model. It's going to give you insight into things that really hadn't been done before. I mean, the WeWork filing was one of the most famous examples of that of all time. That's a story for another day. But If we broaden
You and
out,
I might be rare that we enjoy reading nerdy, like in-depth 300-page S1 filings, but I
no.
agree with you 100%. You get more information there and more learning than most of the public because they don't take that time. And so you can save yourself a lot of headache and heartache and losses by reading into those filings, whether it's an IPO or just a publicly traded company already.
Exactly. Great. And then, so just from a broader perspective, IPOs are hot. I kind of said there's a lot of things that are hot right now that are high risk, and markets are looking pretty highly valued now. So, I mean, do you think stocks need to come down from here because they're expensive, or are you keeping your? I mean, we both are fairly bullish investors over our careers here. I'm the one who's getting a little nervous, maybe because I'm getting old now. But I mean, how are you feeling right now? Do you think stocks need to cool off?
So I think it's not a time to be an indexer. It's a time to be a stock picker. And I
Yeah.
think that to your point, it's because of valuation. So is AI real and is the spending tremendous and going to lead to lots of growth? Absolutely. You have, Meta, Alphabet, Microsoft, and the likes of Amazon spending over $300 billion, right? So Meta's spending more money on capex this year to build AI than it makes in profits in the last 12 months. That's a real trend. Do you play that buying Nvidia at 35 times earnings? Absolutely not. I go and look at a company like NXP Semiconductors that's levered to all semis and it's trading at 18 times. I think, other places in the market, you got to look for value. So I look at energy, right? My day job is with an oil and gas, small cap, growing into a mid cap oil and gas company. But forget that. You don't even have to take that speculation, right? Our insiders are buying, but you can just buy the XLE, the ETF, which, energy is the most undervalued and the least expensive sector in the S&P 500 right now. Yet, arguably, it's the most critical because the global economy still runs on fossil fuels, and you're seeing oil prices tick higher. So, to your point, yeah, I get alarmed when Bitcoin starts hitting new highs, when IPOs are doubling out of the gate. It's a little bit frothy. The other thing you're seeing is hedge funds were short, right? Very quickly net short going into the Liberation Day. They increased their shorts and now they're just getting back into the market aggressively, which is a telltale sign that there's too much groupthink. So we do need some type of correction. I don't know. It could come when the Fed, disappoints everyone by not cutting rates by September, like everyone anticipates. It could come from tariffs leading to inflation. I don't know that the war between Israel and Iran is going to cause it. The markets tend to overlook wars pretty quickly. I mean, the average drawdown is about 6% over 17 days. And then 16 days later, we're back to where we were. So, yes, all that to say, that's a long answer to a really short question that you asked. The short answer is yes, be conservative, be opportunistic, don't overpay. Don't be chasing momentum, high valued stocks, whatever sector they may be in, because I think you're probably setting yourself up for having to average down in the short term in those names before they work out.
Well, that's great perspective. There is, I mean, so much going on right now that the last thing we mentioned was a war, right? So it's a lot to keep your eyes on. But Lou, this is great. We'll check back in with you maybe when some of these IPOs are coming out, or oil and gas, all sorts of things we can bring you in for. But Lou, actually, where can people find more of your work if they want to look you up?
Yeah, the easiest place is go to our website, thebigskinny.com. It's got links to our latest shows on YouTube, or you can find us on Twitter. I can't call it X. It's still Twitter to me. You can find me there. And then, don't know what your daily TV consumption involves, but if it involves Fox Business or Yahoo Finance, I'm weekly there helping co-host. And so I try and share ideas freely. So there's no holding back here. It's we'll give you tech ideas that I'm investing in, as well as energy and oil and gas stuff too. So that's look forward to connecting with people.
All right, great, Lou. Thanks for being so open with all these ideas. Everyone should check out Lou on The Big Skinny, and you can also stay up to date by following Stansberry Research. We produce free, high-quality research on all kinds of market opportunities, so sign up for free at stansberrydigest.com. You can do that right now, and be sure to hit like and subscribe here on YouTube so you never miss our market insights. That's all for today. I'm Matt Weinschenk, and we'll be off next week, but I'll be back in July with more market insights that you can put to work in your portfolio.